Good morning. Thursday, the 20th. US bond yields starting to stabilise this morning after Scott Bessent's latest attempt to control the bond market. After trying actual war, President Trump reverts to economic war against Iran. We're going to talk about that. And SK Hynix went first. Samsung could be next. Big buybacks this morning, boosting the Cosby, Tom.
Not boosting European futures, though. European futures pointing to a seventh straight day of losses for European stocks, pointing low by 0.2%. This is the story of the day, though. As you were saying, Guy, it is that rally in global bonds on the back of that intervention from Scott Bessent. And you're seeing that pronounced in JGBs towards the long end. This is the 30-year yields currently down 11 basis points. Brent is edging higher by 0.2%, $91 a barrel, closing in on 92. The countdown to the opening trade starts right now.
Morning. How you doing? Thursday morning. So yesterday, the Treasury Secretary in the United States made his latest attempt to control the bond market. We've tried the SLR, the supplemental leverage ratio. We've tried yen intervention. That's a kind of story that we've watched as well. There's lots of different ways you can try and control the bond market. Yesterday, it was about buybacks, big buybacks, doubling of buybacks, basically trying to target the long end of the bond market, bring yields down. President Trump clearly not happy that borrowing costs are going up, not down. We'll talk about the economic theory behind that maybe later in the programme. But here we are this morning, stabilisation in the bond market. Is it going to work, I think is the question. Is the latest attempt to control the bond market going to work, or are there bigger forces pushing yields higher?
I mean, it feels very much like a Band-Aid, right? You had a doubling in buybacks and you got 10 basis points on the 30-year. And you think about the Treasury market in general, it's massive. It's 30 trillion. 6 trillion of that or something is the 10 to 30-year point. And so there's really a big question about how much can it actually push down yields and what are the repercussions in other markets in terms of the problem is investors want greater compensation for greater risk. If they don't get that compensation from yields, they'll get it from the dollar. Yeah,
dollar went down. The big move in euro dollar yesterday. I'm trying to think about how it translates into the rest of the world.
Moving average, and you saw a rally in gold, and you saw a rally in Bitcoin.
Didn't see a rally in stocks, though, did you? Not a big one yesterday.
Is this a question? JP Morgan raised the question as to whether or not this is a credibility risk now for the US Treasury and for Scott Bessent. Does this raise questions about the credibility of the Treasury as they look at this sort of an intervention without a government, without either party looking to address the $40 trillion now, $40 trillion overall debt pile for the US government?
I mean, I think absolutely, right? Buybacks are meant as a market functioning tool. There's not a problem with market functioning. Yes, 30-year auctions are coming in at record highs, but bid-to-cover ratios are reasonable. There's nothing really wrong. It's not a crisis. And so why should you do something that eases financial conditions? And that potentially brings in worse as well in terms of the bond market was tightening. It was doing the job of war. So if you now have easing, does that mean you have an issue again from a credibility standpoint for the Fed?
All of those questions. And I think the answer is, you're going to start challenging the Fed on this as well. Where do we go with this, though? What I don't get is, to your point, is it's a Band-Aid. So the fundamental problem is you've got huge amounts of debt. But I don't see any evidence that the US is going to cut taxes, cut spending, raise taxes, cut spending, do anything about this. We're going into the midterms with the Americans talking about, the Republicans talking about trying to find ways to cut taxes again. This isn't, Bessent's doing this, but the Republican Party is doing this, and it's going to make it harder, not easier, to tackle the fundamental problem. So do we get higher yields here? And what is the implication for the rest of the world? We all price off the US Treasury. So is the UK, is Europe, is the rest of the world going to be facing higher yields because of what is happening in America? What's the currency story going to be on? There are so many kind of ripple effects that come off this you are fundamentally changing the price signal on which the world operates. This is the price signal. Friedman, Hayek, sort of deep concerns about this. This is the price signal you need for the global economy to tell you where north is. And they're messing with it.
And does it create a bigger problem down the line in terms of that shift in issuance means you have to issue more at the front end. More front-end debt means when yields rise as the Fed hikes, that becomes even more expensive to fund your deficit. And, it just adds to all of these problems that seem very systematic, very much like they're going to go on forever, including the Strait of Hormuz. We've had more headlines overnight around Trump saying we're going to do massive economic sanctions. We still don't really know what those are. He said that they'll target trading partners. Again, not
China?
naming specifics, but yeah, China is what you bring in there because you go, well, 90% of Iran's oil goes to China. You've had the UAE say we're not going to do any business with Iran, but does it really create that much pressure on them?
So the UAE is a win for the Trump administration in terms of their decision to cut their ties, economic ties with Iran. But you cannot solve this without addressing China. China is the key support for Iran right now, economically. And are you prepared to pick that fight? Is that the fight that Trump wants to pick right now, with President Xi Jinping heading to the US? Maybe he is. Maybe they're prepared to go there. But that's what it will take to exact real economic pain on Iran, on an Iranian regime, of course, that's dealt with this since the 1970s. But you could ramp it up if you were to really punish China. But that comes with all sorts of additional risks, not just for the US, but for the global economy as well.
So let's assume that that's not going to be the case. Therefore, let's assume that this probably won't work. Is that the assumption we're working with now? So Iran remains in control. This takes a long time to have any kind of effect, probably won't ultimately deliver what the Trump administration is looking for. The UAE connection is significant. The connection across the Gulf is massive. And whether or not the UAE dials that up or dials that down, I think is going to be significant in terms of cutting off Iran from the rest of the world. But nevertheless, China is pivotal here. And to your point, do you want to pick a fight? And if you don't want to pick a fight,
then it's a war of attrition.
Yeah, but it's a really long war of attrition, and one that probably leaves the oil price higher.
OK, so can the equity markets look through that, as they have done, because of the compelling nature of the AI story? We've been talking about buybacks. This is a day of buybacks. It's not just the Treasury, but it's also SK Hynix, of course, with that news yesterday, but Samsung as well, reportedly looking to do a similar move to buy back and return cash to shareholders. Interestingly, there's some analysis from the likes of JP Morgan suggesting that SK Hynix could ramp up buybacks even further. So they came through with the news of $29 billion yesterday, SK Hynix. JP Morgan suggesting that could move to an additional $130 billion over the next 12 months or so. The stock is down. SK Hynix is down about 40% since the highs in June. So on some measures, this is management saying that the stock is not reflecting the fundamentals. We buy back. It's cheaper. We can continue to invest in the fabs. They've made those commitments. We can do both. Two things at the same time. Seems to be the take, at least. Is this positive? It's putting some stability around the chip story, at least for now. The stocks was down again yesterday. That was another example, arguably, of another tech company in the US looking to tap the markets. But in Korea, this is something now that is adjusting and putting something of a floor under the chip makers, at least for now.
I mean, does it prompt divergence between Asia and the US in terms of those are the big stocks within the Cosby, and if you have supply going down there, there's less demand for capital, there's less of this competition in Asia than there is in the US, and so maybe that means that those indices do better as a result.
Another way of looking at it might be that we've come down a long way, we've bounced a little bit, but it doesn't feel like a convincing recovery to the highs, does it? Is there a signal in there also that the market is clearly nervous? We've kind of come off our lows, but we haven't recovered completely. And is there a signal from management saying actually that we think the market is still underpricing kind of where we are right now? We should be back up there. I don't know. I keep watching the Cosby, waiting for something more convincing to come through, and at the moment it feels half-hearted, the recovery that we've had back. It's a big number, but relative to
there's no evidence that the demand for what they actually produce, high bandwidth memory, is slowing. No. There's no evidence of that right now.
But this is a market that is prone to big swings.
Yes.
And we're just seeing evidence of that, I think. Anyway, we're going to talk more about what's happening in the energy market. Carol Knackley is going to be joining us from Crystal Energy. Benny Okong's going to be along from Diamond Asia Capital, partner and portfolio manager there. We'll get his take on what we got from Bessent yesterday. John Turek, JST Advisors founder and CEO, joining us on that same story as well. And Dan Akarca, Callosum co-founder, joining us a little bit later. Wait for that interview. Make sure you stay tuned for that interview. I think it's going to be really interesting in terms of what he's going to tell us about chip demand, high-end chip demand, whether or not you need the high-end chips for everything. They've got some really cool technology. Anyway, we'll talk about that later.
OK, let's look ahead at what else we are watching throughout this Thursday, 8:30 a.m. UK time. The Riksbank policy rate decision will cross. We'll break that for you, of course. Sweden in focus. Also today, Monty Paschi, the board members are set to review strategic alternatives to Intesa's takeover bid. We also have earnings coming through from Alibaba at 11 a.m. UK time, and with a continued focus, of course, on the US retailer, with retailers reporting this week. Walmart is the big one at 12 p.m. UK time. And at 1:30 p.m. on the macro front, we also get a US initial jobless claims, and later the ECB governing member and Dutch central bank president, will be speaking on central bank independence.
Big test of the US retail story later. Yeah. We saw retail sales a little weaker back end of last week. Today we get kind of real on the ground kind of lessons from Walmart. And what are they going to tell us? And if Walmart does well, is that bad for the US? Is that a bad signal for the US, the sort of consumer? People are trading down. Is that the narrative? I think reading between the lines is going to be really interesting today.
Yeah, I mean, especially because the retail sales print, there were questions around how reliable it is in terms of Prime Day being on a different month.
That's true.
Also, you know, World Cup distortions feeding in there. And so if you have 2Q earnings from some of these big retailers, how is that showing up in terms of the consumer still doing well? I would assume, though, that like better earnings would be more positive for your lower end consumer, where you have a higher propensity to consume, and that's a more positive signal for the economy.
And obviously, the lower income consumer is that much more susceptible to higher prices. So sometimes you see really interesting details in terms of the volume and the shift across different product lines and what that tells you about how much pressure there is.
But if more middle-income people are trading down. What does that tell you about the kind of the state of the economy? What does that... it's that kind of demo difference that I think is really interesting in terms of Walmart clearly has control of the lower end of the market, but if more people are joining that group and trading down to white goods and all this kind of stuff...
Does this all tie together with what the Treasury Secretary's been doing?
Well, partly, yeah. I think that's partly a factor. Mortgage rates are very high in the States now. They're, circa 7%? That's a story that obviously resonates pretty quickly. Gas prices are pretty high. We're going into the midterms. All of that fits together. Coming up, the US is set to maybe cut tariffs on Canadian metals and autos. We'll discuss that. What does it mean for the Trump agenda? We'll figure that one out. Plus, Asia Tech in focus. We'll preview the results. Baba's out a little bit later on today. We're going to have more on the company's AI ambitions as the race for global dominance obviously continues. Up next, we're going to be speaking to the Aegon CEO. Lard, Freise is going to be talking to us. The Dutch, still Dutch, insurers' profit beat coming through this morning. They are moving, though, to the United States. We're going to be talking about that. Any questions you want to join in the conversation, we'd love to hear from you. IB+, BB, TV Go is the function. This is Bloomberg.
We are a little under 45 minutes away from the opening trade this Thursday. European futures are flat on the top line on Stock 600 after 6 days of losses. FTSE 100, though, called to very modest gains of about 13 points. You're running low on the DAX, as you can see. The CAC current looking to add just 5 points. This is a market, it seems, looking for direction. Again, called flat across the benchmark.
Felt like a familiar theme. Just slight drifts downward over the last few days, as you were pointing out earlier, Tom. Let's talk about one of the big corporate reports we're getting through this morning. Aegon has reported operating profit in the first half that beat estimates. The Dutch life insurer, and it's not going to be a Dutch life insurer for much longer, and asset manager, also raised its share buyback plan for the second half, 150 to 350 million euros. Let's start there. Lard Freise is the Aegon CEO and joins us now. Good morning. Why such a big increase in the buyback? What drives that? What gives you the confidence to do that?
Yes, good morning, and thank you for having me back again on the show. This is all a signal of capital strength and continued momentum that we have with the company. We have a 1.7 billion cash buffer at the holding company that we aim to bring down to roughly $1 billion. We have printed today a very strong set of results with 27% uptick in our operating capital generation. And if you look at the capitalization of our subsidiaries, it's very strong. And this allows us to do two things today in terms of capital return. One is to announce an interim dividend that is 11% higher than last year per share of 21 cents per share, and an increase in the buyback program with 150 million to 350 million for the second half of this year.
Now, the solvency ratio has come down from the kind of the mid-180s, let's call it that, circa mid-180s. We're now, I think, in the high kind of 160s. I think the floor that you set is kind of 150. Kind of where do you think the sweet spot is that you want to get to in terms of that number?
The group ratio is not what we should be focusing on. It's really the operating levels for the operating companies, because the holding company is just a derivative of that. The operating result of the operating solvency ratios of the holding of the subsidiaries is very strong, with 420% RBC in the US, but also the other ones in a very strong position. What you're seeing in the group ratio is that in the context of moving the company to the US, some of the bond instruments have been called by us in this half year. So this is all about the repositioning of the company. The focus is really on the operating company subsidiary solvency ratios, and they're very strong.
Lard, on that move to the US, what's top of mind for you in terms of potential execution risks with that operation?
Well, it's quite a complex process, right? We, driven by our conviction that the U.S. market is a structurally conducive market for us. It's the largest life insurance market in the world, and we have a thriving franchise there called Transamerica. Over the years, the relevance of Transamerica in our group has become bigger and bigger, and as a result, we're embracing the reality that the U.S. business is really our largest company, and we want to make it our home market. So we announced that we will move our legal seat and our head office to the United States, and that as we enter the United States in the beginning of 2028, we will also assume the name Transamerica for the holding company. That is a complex process, which is actually going very well, as you can see from all the things that we are doing to execute upon that. We are on track to get there. We are implementing US GAAP. We're moving our head office, setting up our new head office in New York. And as a result, we're on our way to the United States.
Does it always also tell us something, or at least signal something about Europe's space and Europe as a place to run a pension insurance and asset management business?
In our case, it's a very pragmatic embracing of a reality. Due to the success of our U.S. business over the last years, it represents now more than 70% of our group. And it's only logical that you at a certain point ask yourself, what is my identity? Where do I need to be? If 70 to 80% of our business is in the U.S., we want to turn it into our home market. You can only do that if you're close to it, a part of it fully, and as a result, we're moving our legal seat and our head office to the U.S. So it's really driven by that and by the opportunity of the U.S. marketplace for us. Mainstream American families are underserved by the financial services industry for quite a long time, and we have a unique capability in the U.S. with a distribution organization with now more than 100,000 agents that are sitting down with mainstream American families to help them navigate through their personal finances. And with our brand Transamerica, a very strong platform that has been there for a very long time, since 1908, we think we're very well positioned also in the future to structurally benefit from the growth that market has to offer.
You have a view over Americans' retirement and insurance decisions. Is the U.S. consumer becoming more cautious?
The U.S., we're not seeing that back in, let's say, our sales. If you look at the commercial momentum that we show that we demonstrate also with this announcement of results today, our life insurance sales are up 54%. Our retirement plan business is doing very well with strong commercial momentum. So across all the product lines in the U.S., we're growing. So what that tells me is that mainstream American families become more and more aware of the realities that they need to save for later, prepare for retirement, and make sure that they protect their families to navigate through life successfully. So far, that is what we are seeing in our results.
Are you seeing any shift in what products consumers want because yields are higher?
Well, what we are seeing is that customers, it's in different parts of the business, a different profile. In some of the retirement plans where customers are older and are closer to retirement, we do see a pickup of accessing the money in their retirement plans earlier. That's one thing that we see. Because the markets have been high, they've accrued a lot, and they're very close to retirement. So that's one thing that we see. Secondly, what we notice, and this is demonstrated by the 54% uptick in sales in life insurance, is that younger families are really wanting to ensure that they position themselves well for their children's futures, for their own futures as they navigate their life. So it's not a one answer to, it's a reality of the different profiles of customers that we service.
Okay, Lard, thank you very much indeed for your time. Lard Freise, Aegon's CEO.
OK, what else do you need to know this Thursday morning? Let's walk you through it. A campaign of Russian attacks on Ukrainian ports in the Black Sea has virtually halted all grain exports. The ports of Greater Odessa usually account for around 90% of Ukraine's grain shipments. The delivery deficit deals a severe setback to the wider economy as agricultural shipments account for more than half of the country's export revenue. Fold this in also to the wider food inflation story we've been talking about. China is using new legal powers to block European Union scrutiny of alleged state support for its companies. Beijing barred organisations or individuals from assisting the EU with its probe of JD.com's plan to take over the German electronics retailer C Economy. China's Ministry of Justice said the EU was, quote, arbitrarily demanding broad and unnecessary information. And Bloomberg has learnt that Canada and the US have reached a tentative trade deal that would lower US tariffs on certain Canadian exports of steel and aluminium and cut duties on Canadian auto export. Sources say it's part of a broader pact that would see Canada drop retaliatory measures. It comes less than 24 hours after the US President Donald Trump paused planned 50% levies on billions of dollars of Canadian goods to allow more time to negotiate. We all happy?
I mean, the steel and aluminum tariffs are the big deal in terms of quite a lot of the auto tariffs are exempt under USMCA, but steel and aluminum doesn't have that USMCA exemption. So if those come down, that sector of the economy would be boosted quite significantly, and that's really where the tariff pain in Canada is.
This could all come apart if Carney can't convince some provincial leaders to halt their ban on stocking US booze.
Yeah, and that's what I'd be surprised about is the impact that appears to have had in terms of the American negotiating position, because it's become, as you pointed out yesterday, the Canadians have pushed back quite hard. And that changes the dynamic in terms of the negotiation. America can't just arbitrarily say, we're doing this, this and this. They need to get something back in response. And that has maybe balanced the tables a little bit.
And apparently Carney's been making calls to provincial leaders to say, look, we need to get this deal across the line.
It's time to
ease up on that.
And some of these provincial leaders are very outspoken. Doug Ford in Ontario came out very strongly when the tariff war first started, saying we want big tariffs. And then I think there's also a question of what the Canadian consumer does. Canadians have boycotted American products. They're not traveling to the U.S. in any way, shape, or form to the same extent that they did before the tariff war. So maybe booze returns, but Canadians just don't buy them.
Yeah, you can put it back on the shelves. But will
people buy? Apparently, interestingly, Mexico is now under pressure, that government, to secure a similar trade deal. So that's also one to watch on the trade negotiations front. Coming up, oil advancing for a fifth day as President Trump announces measures intended to crush Iran's economy. We're going to discuss what that means for energy markets with Crystal Energy CEO Carol Knackley. That's coming up. This is Bloomberg.
Uh, 7:30 in London, half an hour to go until we start equity trading here in Europe. Futures broadly positive this morning, I think. That is the story. Not exactly excitingly positive, though, I think probably is maybe the story. US futures are a little bit more buoyant, actually. The Nasdaq is up by 0.5%. E-minis are up by 0.2%. But it looks like tech is going to have a better day stateside this morning.
The action in the bond markets right now is in JGBs, where you're seeing a significant bid, less so when it comes to European debt. As you can see, pretty stable so far this morning, 325 on the German 10-year, and you're seeing a similar picture over on OATs and BTPs, of course, over in Italy, holding above that 4% level. Yields, of course, generally, globally, what we've seen in the last 12 hours on the back of Scott Bessent's move is a story of falling yields as and after the US Treasury said it plans to boost buybacks of longer-dated bonds. Former St. Louis Fed President Jim Bullard said that the decision seems like an important tactical move, though a little unexpected.
The market reaction suggests that this is an important tactical move from the Treasury, a little bit unexpected, so you're probably getting outsized reaction right now. But I don't think it changes the fundamentals of big fiscal deficits and a Fed on the sidelines, which is what's driving longer-term yields higher.
Well, let's bring in Garfield Reynolds right now from Bloomberg's MLIV team. Garfield, the fundamentals have not changed, to Bullard's point. So does this bid for the long end fade and fade pretty quickly?
Well, it might take a while to fade. A lot of that depends on how the data develops. We have data coming out next week that's going to give us an update on where PCE inflation is. That might have a major influence. If that shows some softening, that has investors thinking, well, yes, the inflation problem's not so severe. The Fed can soft talk things. That might help to cement a downside for bonds in the short term. Over the longer term, though, as Bullard was just noting, we still have deficits. We still have lots of interest payments that the US is going to have to come up with. That's been creating a vicious cycle. And you could even argue that we have concerns about the US government's willingness to intervene in markets to manipulate yields down artificially. That might help to push some investors away from Treasuries, some investors who've already been moving away from Treasuries. We've seen foreign central banks cut more than $300 billion from their stockpiles of Treasuries based on what the Fed reports since April 2025. So that's a theme that's going to go on developing.
It was only a few weeks ago that Bessent was talking about the fact that he wanted the Treasury and Treasury action to be predictable. This wasn't predictable. We didn't see this coming. So how does credibility stack up this morning?
Oh, well, credibility's clearly taken a major hit, and you can see that in what happened with the US dollar overnight, both falling against pretty much every major currency and falling a lot against the Swiss franc. That's a currency that gets a lot of love whenever there are US dollar credibility concerns, and the huge jump in gold. So that's a concern. There's also going to be, I think, a revival in investor concerns about where the Fed stands with all this. We had Chairman Warsh talking about the idea that longer term rates were to some extent, with those moving higher, that was doing some of the Fed's job for it, was the implication, and that the market should get used to the Fed not offering guidance, and it should play the ball, not the man. And Scott Bessent has put the man right back in the center of things.
Are there then implications for the Fed in terms of if this is financial conditions easing, is that more of a bias for hawkishness from the FOMC?
Oh, for sure. And we've had, the minutes that came out overnight got a little bit obscured perhaps. Those showed a market hawkish turn amongst the FOMC members. So while Warsh in his press conference sounded a little bit less hawkish, the Fed as an overall institution is sounding hawkish, and they're going to face this difficulty too, in that if one of the things that what Bessent is doing is further boosting the US government's reliance on the shortest term borrowing in order to fund things, including buying back long-term debt. So if short-term issuance is surging, and it is, how does the Fed hike rates, and what are the impacts of that? So that's going to put a lot of pressure on the Fed in general, along with the concern that what Bessent is doing is going to create further risks when it comes to what might happen with inflation, and mean that they might want to need to lean against those extremely loose, relatively speaking, financial conditions. Depending on which gauge you look at, they might be as loose as they've been since 2022. They might be even looser than that.
OK, Bloomberg's Garfield Reynolds. Garfield, thank you very much indeed for those insights. So staying with the inflation story, oil advancing for a fifth day as US President Donald Trump announced a package of measures intended to crush Iran's economy. That's the intention, at least. The two sides remain locked in conflict, of course, over the Strait of Hormuz, a chokehold restricting flows of global energy supplies. We're joined now by Carol Knackley, CEO of Crystal Energy. Carol, what do you make of this plan by the Trump administration, and to what extent is it being priced into oil at this point? How much could we see further energy supply restrictions on the back of these measures? We're still waiting for details, but there is maybe a playbook.
Well, what I see today from the announcement from the White House to in terms of imposing further restrictions on the Iranian economy, I see it more as a continuation of the maximum pressure policy that President Trump is very fond of, not from his second term, but also it goes back to his first term. And already, I mean, there is no doubt, and we cannot deny that the Iranian economy is suffering, but it has been suffering for decades. And if you look around the domestic the local inflation, the shortages, but it's very different from saying that will lead to a crippling of the Iranian regime, which was built to resist for as long as possible. So there's definitely the additional pressure which could force Iran maybe to accept some concessions so that we get to a deal. But I don't think it's going to end the stalemate immediately. It failed to do so many years ago and is unlikely to result in immediate resolution of this stalemate. It can last for a while. Now, to go back to your question about how much of that is factored in the oil price. Actually, the oil price, what we are seeing today, this jump above $90 a barrel for Brent, is definitely a reflection of geopolitics. I don't see much changes, many dramatic changes on the fundamentals, but definitely I see, for example, the negotiations to open again the Strait of Hormuz, Oman, Iran negotiations or potential deal fell apart. The White House stronger stance on Iran, and more importantly, we saw recently how the UAE announced it was cutting ties, complete economic ties with Iran. And that is an additional layer of complexity when it comes to geopolitics, because for decades, the UAE and Iran had very strong economic ties, trade relationship. Go to Dubai, you see the Iranian living there all over the country. And for that measure to happen today, it tells me that GCC countries' patience with Iran is wearing very thin. So that adds another layer. But my question back to you is not why prices, despite the deterioration in geopolitics, why prices are only 90 and not 150. And that is really the interesting question.
Well, because you talk about the determination as well, you've referenced that, their determination to continue to supply the market out of the Gulf nations. So that takes us to the physical supply. What is your read right now, Carol, on the physical supply through the Strait or other overland routes or other means in terms of getting oil into the markets? What is your count right now in terms of barrels per day?
Look, for years and decades, we always argued that demand was a main market fundamental that is very difficult to account for. But today, the picture applies also to supply, because if you look at the numbers that are coming from the Gulf, there is a very big widespread. For example, we heard Chris Wright talking about 9 million barrels a day, whereas industry observers, those that supply like that, tracking of tankers, they are talking about half of that number. And let's be honest here and humble. Nobody knows for sure, because ironically, the dark fleet practice that Russia, Venezuela, and Iran, Russia is still using that, Iran to a certain extent, wherever they could get their oil out of the Strait. So that practice has been well established, and we learned from it. I'm not saying that we have dark fleet, but at least, switching off your transponder, your data location, all this is happening behind the scenes. So we cannot really put a big number on it. And there's also diversion away from Hormuz, from the UAE, straight to the Gulf of Oman, or also into the Red Sea. So the prices to be where they are today tell me that there is a lot of oil still making it to the market, but really we don't know for sure how much of that oil is making it through the Strait of Hormuz.
Okay, Carol, so given all of that, let me throw the question back at you. You clearly don't think the oil price should be at 90. Where do you think it should be?
Well, actually, I think 90 is quite a good reflection of the situation. I don't think the oil price should be at 150 because if there is one lesson I will take away from this ongoing crisis is the lesson of adaptation. All previous crises in oil, they were more like, I don't want to say more short-lived because they were of a different magnitude. But if you take into consideration the losses that we are seeing, the disruption affecting the most important producing and exporting region into the world for oil, for refined products, for LNG and other products, and then prices to be where they are, tells me that it's not, oh, the market is underestimating. It tells me that actually there is a much bigger resilience in the system that analysts tend to appreciate. Even oil's importance to the global economy is not the same. It has diminished. Demand is responding. But the problem with that new reality, while it is good news from a consumer's perspective, it's actually bringing another layer of complexity that is because of the market's adaptability, its ability to face such a scale of crisis with resilience, bigger resilience. I'm not saying it is continuously resilient, but volatility is not vulnerability. I would say that the big danger is that we may not see the crisis being resolved anytime soon, because take the US, for example, it is really benefiting to a large extent from the current situation in the Middle East in terms of exports of oil, gas, refined products, LNG. So it's not really as bad as it used to be for the US in the past. Now, what the US can afford, other countries cannot afford. I'm thinking about the GCC countries, but because the US is the main player and it can afford to wait, and the market is not collapsing, the economy is not collapsing, the global economy is still weathering the storm in a much better way than many expected, I fear that the crisis might last much longer than we hoped for originally.
I mean, that's certainly what betting markets are saying in terms of there's a below 50% chance from that perspective that the Strait is open by July 2027. Saying we get there, do you have enough mitigating factors, resilience, that oil prices can trend down in that direction, or do we just go steadily up from here?
So let's separate between two things. First of all, the uncertainty that we are seeing in the market today because of geopolitics will continue to be factored in the oil price. And that's why you are seeing these massive swings, and they are happening almost on a daily basis. And you don't see these swings when you have sudden change in the data for demand or sudden change in data for supply. They take time, and they can tend to be much more lasting. So there is a geopolitical risk premium. As long as we have this kind of uncertainty, this verbal roller coaster, one day we love each other, we're about to sign a deal. Another day I'm going to squeeze you until you accept my terms. So as long as we are on this roller coaster, we should expect to see not $1 or $2, but I would say a couple of 20s of dollars added into the oil price. On the market fundamentals, I would say there is no shortage of global supplies of crude oil, despite the warnings and everything. Actually, the picture is not as concerning. And don't forget the demand side, the demand story. The IEA is expecting a loss of 1.6 million barrels a day. And OPEC, in its latest market report, they are expecting a growth of 0.6 million barrels a day, or 600,000 barrels a day. Now, for OPEC, they say it's a modest downward revision from last month, but actually it's quite significant compared to what we saw earlier in the year in their forecast, when they were predicting a growth of 1.4 million barrels a day. So when you put these factors together, you're saying that the current level, if the situation continues as it is in the Middle East, we can expect the price swinging between the 70s and the 90s.
70s to 90s. Okay. I can set respects. That doesn't sound too bad. Carol, thank you very much indeed. Carol Nachley, the CEO of Crystal Energy. How does the bond market take that? Would that be welcome? Well, investors certainly weighing in on the elevated Treasury yields that we're seeing right now.
I really dislike that phrase that interest rates are going to stay higher for longer, because it implies that somehow or other we should be getting to lower interest rates. I think we're back to normal interest rates. 4 to 5% is normal. I think it's a healthy sign of a healthy economy. It's a sign that the capital markets are properly allocating capital, and the economy can deal with it just fine.
Not sure the Treasury Secretary feels that way. Anyway, Ed speaking yesterday, I think before we saw the action from the Treasury, the president of Yardeni Research speaking, I think, on surveillance first thing yesterday morning. We'll talk more about the latest bond market acts. We'll do that next. This is Bloomberg. A little bit of a bid coming back into the bond markets. We're 11 minutes away from the equity market open. That's what the equity market looks like. I'm not sure the equity market is the focus of attention right now. We've been sort of steadily drifting a little bit lower, so it'll be interesting to see whether we actually finish today higher. But there's a bid back in the bond market, which seems to be, as I say, the focus. OK, markets in 3 minutes. Paul Dobson's here, executive editor, Asia Markets. Paul, Scott Bessent has tried many different ways to bring rates lower, long yields rates lower in the United States. Is his latest attempt going to be successful?
Morning, Guy. I think that the short term, you can say with some confidence that, yes, the market has taken this relatively positively. We had a pretty decent move at the back end of the yield curve yesterday. The Bloomberg bond index for US Treasuries due in 20 years and more had its best single day since February last year. So certainly he's got a little bit of short-term momentum. I think those off-the-run bonds that he's targeting also narrowed a little bit. So the liquidity there was improved somewhat. Citigroup is saying, this is a top for yields. We should be comfortable from there. But I think that the growing consensus, or the bigger consensus within the market, is there still needs to be more if you really want to keep a lid on yields coming through longer term. The US is running this big budget deficit, 6% at some estimates. If it doesn't at some point take more measures to actually get spending under control and to bring down that debt load, or at least keep it contained, then the pressure for higher bond yields is just going to continue to bubble up.
If the pressure for bond yields to go higher continues, does that mean your other feed-throughs to other markets, like a weaker dollar, like the bid you've seen in other bond markets, is that set to be finite as well?
So I think that as long as the yields are contained to a certain extent, then you might find that the pressures squeeze out in other ways, Skylar, if I can answer it that way. So in a story we have looking at what the implications might be for the US dollar, one of the people we spoke to called it a sacrificial lamb, which I quite like. The idea that if you are going to keep a lid on yields and do more to try to achieve that, without actually addressing the root causes, then what you're going to see is instead that expressed through a weaker dollar. And indeed, that's another thing that we saw during the last sort of session, where we saw not only other currencies, particularly things like the Korean won, really bursting higher, but also gold and Bitcoin getting a bid again.
Yeah, and the dollar falling below its 200-day moving average yesterday. Paul, just briefly reflecting what's happening in Korea, what do you make from your position in the region of the action we're seeing from the likes of Samsung and SK Hynix to maybe put a floor under their stocks with these buybacks?
Yeah, so it's really interesting development to buy back almost as much as they raised in the US is certainly giving them a little bit more support in the markets. And it's just the volatility in those Korean stocks is extreme at the very best of times, or worst of times, depending on which way you look at it. I think they've got that extra fillip from the strength of the Korean won, so that's lending people a little bit more confidence, and you see overseas investors putting more money into Korean stocks as well now.
OK, Bloomberg's executive editor for Asia Markets, Paul Dobson. Paul, thank you. Let's get your stocks to watch this Thursday. Alex Morgan is standing by. Alex.
So it might be a bit disheartening from a European perspective to begin on a firm so set, so focused on the exit door. But let's look at Aegon. Their move to the United States is really the big story here. They've reported operating profit for the first half of the year. They did beat estimates, but they're down pre-market around 5.9%. That's because analysts digging into this saying that actually a lot of the good news coming from one-offs. The departure announced of their CFO, also seen as causing a bit of instability. But Aegon is looking to make that move to the United States. They've announced they're going to be holding a meeting of shareholders in October to look for their approval. Of course, around 70% of their income actually does come from the United States. So that makes sense there. So the broader story, Aegon looking to the exit, but analysts seeing some near-term sort of ripples, if you like, coming from the departure of the CFO. Let's turn over to Novonesis, the biotech firm. They make biosolutions, enzymes. They've seen a real lift from dairy and high-protein products. Year-to-date up around 1%. This year-to-date up around 1%. Yeah, Morgan Stanley expecting them to outperform, although it's interesting to see other analysts saying that there could be sort of more in line with the rest of the sector. There could be other headwinds that they may not be quite as outstanding this morning. But do keep Novonesis in mind. unwind. And let's finally turn to the train line. They had their worst day in 5 years yesterday. The stock down as much as 17%. Now, that is the online ticketing platform. And this came off the back of the news that the Competition and Markets Authority in the UK, the watchdog, was investigating something called drip pricing. That's where consumers are not shown all the costs up front, but are then confronted with it at the end. Now, of course, launching an investigation doesn't mean wrongdoing at this stage, but JP Morgan has cut to the lowest across the board this morning for the train line. Overall, though, the picture still 11 buy, 1 hold, 1 sell. So there is that broader picture for the train line. Worth saying they're saying they will cooperate with that investigation into those pricing practices.
OK, Alex Morgan with some of the stocks in focus today. The big picture story, of course, is the action from the US Treasury Secretary. The bid for Japanese bonds continues. There's a modest bid for European debt. We'll look at gilts as well at the open. European futures currently flat. The opening trade comes up next. This is Bloomberg.
Thursday morning, good morning. The big surprise yesterday was in many ways not the reaction in the Treasury market to what Scott Bessent did, but actually the lack of reaction in the equity market. That was actually a bit of an eye-opener for me. You've got a big reaction in the dollar. That was understandable. Gold obviously moved. Equities just didn't, and that was definitely a shock. The Stoxx 600 was down yesterday. This morning it's called a little higher. That's the kind of the narrative we've got going into the session this morning. Are we going to break the downtrend? I think Tom was talking about it being 6 days down over the last few sessions. Are we going to break that today? Well, it doesn't look convincing, does it? It doesn't look like we've got a clear sense of direction. 50 futures are down a touch, FTSE's up a touch, DAX futures absolutely flat as a pancake this morning. So there's no kind of obvious sense that we're going to break that trend either way at this point. So I don't know. It's very hard to call. Tom, what have we got on single stocks? Individual names to focus in on. We're going to be watching the luxury space at least. There may be a read across from a share drop coming through from Coty, which is the beauty conglomerate. Fourth quarter results coming through and an EPS miss. So we're watching the luxury space. JD Sports, interesting in terms of the subdued outlook. So they're cutting their profits outlook. Subdued demand for trainers, apparently, from JD Sports. On the upside, Novonesis coming through with a beat. The biosolutions company. So watching Novonesis on the back of that could see a bit of a move higher in that stock going. I'm going to need a new pair soon, so maybe that'll move the dial. OK, here we go. Let's talk about where we are with these markets. Let's talk about kind of what we're anticipating in terms of this open. Equity markets in some ways were left out of the move yesterday. Gold moved, the bond market moved, the dollar definitely moved yesterday. Big move in euro dollar. That was certainly one that stood out yesterday. This morning, bond markets a little calmer. Equity markets, though, remain calm. Maybe kind of caught in the headlights. Maybe that's the better way of looking at it. Let's take a look at what we've got then. Let me show you some numbers. We're not expecting much. FTSE's slightly negative. We're expecting other markets to be slightly sort of more positive, but either side of the flat line, no real clear sense of direction, which has been drifting lower and lower over the last few sessions when it comes to European equities. And that kind of feels like maybe the trend is going to be hard to break today. CAC, not yet open. The AEX will be interesting on the back of what we've seen in maybe out of some of the chip stocks in Korea. But if the chip stocks are spending money on buybacks, are they spending money on kit? I don't know. Tom seemed to think that maybe we would be seeing them be able to do both earlier. So the AEX is up by less than 1/10 of 1%. The IBEX is down by less than 1/10. I've got nothing. Tom, over to you. It's a subdued session. We've got six sectors in positive territory right now. The best performance coming through, at least for the moment. Autos, interestingly, is up 0.7%. On the downside, the biggest losses coming through for travel and leisure, currently down 0.6%. Could be down to a continued grind high in oil prices. $92 a barrel right now, and Brent up 0.7%. Retail also under pressure, down 0.4%. So yes, on the upside, autos leading with gains of around 0.9%. Tech is also pushing through with a little bit of very modest upside of 0.2%. And again, travel and leisure down by 0.7%. The biggest losses, at least for now, for that sector, Guy. Let's quickly just have a moment on euro dollar, because I don't think this kind of feeds into the narrative that we're watching unfold at this point in time, whether or not it becomes a slight headwind. If the dollar does continue to move lower, How does that change the outlook in terms of what Europe is dealing with right now? In some ways, it deals with some of the imported inflation aspect that we're watching, but how does it translate into corporates? It's not a big move, but there was a decent leap yesterday. We're 116.85 this morning.
Yeah, I mean, it's feeding into the pound as well, and you're above that key 136 level there, 116 in euro dollar. It's definitely a bigger reaction in the FX market than what you're seeing in bonds. So gilts yields are down a little bit, but it's very much following the trend of Europe, where it's a subdued reaction to the 10 basis points decline that we had in 30 years on the U.S. side.
Okay, let's try and get some sense as to what is happening here. Benny Okong, partner and portfolio manager over at Diamond Asia Capital, joining us around the table. Good morning.
Good morning. Good to be
here. Were you surprised to see stocks moving as little as they did yesterday on the back of the Bessent move?
I was, really. I think that there was a lot of discussion in recent days that higher long end of rates was really depressing stocks, keeping a cap on things, and so then to see that reversal and not follow through in equities was a surprise. I think we saw anecdotal evidence that there was a considerable bit of pain and unwinding going on in hedge fund books, both on the discretionary and the quant side, so I don't know whether that was a factor yesterday.
In terms of where we go from here, does this stop the train being high yields? And where does that ultimately manifest the most in terms of its significance?
So I think I would concur with the consensual view, which is this is a short-term reprieve. Positioning it got quite extreme, but really doesn't change the dynamics in terms of longer-term deficit spending. Arguably, with midterm elections, there's a potential path whereby actually spending could increase even more. As the Democrats, look to negotiate with Republicans about, getting more of what they want on things like Medicare. So I don't think it changes the long-term trajectory. It's just a short-term tactical, I think, reprieve.
And are there implications for other bond markets, or is it very much U.S. focused? Because we've had a more subdued reaction in Europe and the U.K.
I still think directionally for all the major global bond markets, direction of travel is going to be higher yields over the long term. The deficit spending issue we're seeing in the U.S. is not, as we know, unique to just them. Germany, for example, is going to continue to push down that path. France, very difficult to see how it kind of, changes the direction of travel there. So no, I think it's a broader issue that's going to persist, and I don't think the sort of things we saw yesterday are necessarily long-term structural game changers.
Earlier this week, equities were under a bit more pressure as yields rose, potentially because term premium is rising without growth also rising. Are you worried about that kind of yield rise, or if it's deficit motivated, is that more concerning for equities?
I actually haven't been as worried as some in terms of the recent rise in longer end yields. I think it's been, as you said, a bit more term premium driven, a bit more about real yields moving higher. When I get concerned is really two things. One is because the market is signaling there's some concern of some imminent policy issue or inflation issue. And secondly is when rate volatility is just at a very high level. Rate volatility actually is at a very manageable level if you look at it right now, and actually came down after the moves yesterday. And inflation, although we've been talking about it for a while, doesn't, apart from Europe where we can come and discuss that, I think there's a potential issue there on the energy side. I think generally, broadly in the US is a big concern of now.
Does this action drive the dollar lower? And if so, do US equities become less attractive on weaker dollar?
So dollar lower, definitely. I think this is reinforcement of a signal that trend can persist and continue. And I think if you see on the equal weighted dollar index a break, which we haven't had yet, then you'll see a lot of money jumping back onto that trade in terms of dollar weakness. How does that flow through in terms of the U.S. equities? I think for me it's less of an issue because really the U.S. market is less about exports and the story is really more on the AI side where the dollar sensitivity is not as impactful.
And Guy touched on euro dollar. So for European corporates, where does that land?
I think it's more impactful for euro because I think before yesterday consensus was moving very bearish on euro, for the coming months, and again, considering the energy and winter potential issues, I think this dynamic now gives a bit more balance to the debate. I don't think it suddenly is going to mean the euro, goes on a massive tear. So I wouldn't be concerned again from an equity perspective that it's something we have to really factor in and change dramatically in the models. But it definitely changes the direction of travel versus expectations.
Bernie, do you think the hedge funds have got a handle on what's going on right now? You talk to a lot of people. How confused is everybody out there? I come in on a daily basis and I try and figure out what is happening in the world, and it's really hard. I genuinely can't remember actually it being harder to understand what kind of the dynamics all mean and ultimately where they are going to show up, manifest themselves in a meaningful way further down the road. What are they doing? How are they thinking about the challenge in terms of what they face right now? They're getting pushed from one side of the boat to the other. Leverage is coming in and out. What are they telling you?
Look, I agree. It is a very difficult, challenging time. I would say generally, I think actually it's been quite impressive, the performance of hedge funds across the board. I think what you do see is, though, there's different behavior and performance in terms of the mix. So the ones who kind of thrive on this elevated, short-term volatility, have a broader diversification across what they do, they tend to do a bit better. I think having a focus whereby you're relying upon being able to predict with high conviction what's going to happen in the next 12 months, that's very difficult right now. There's so many moving forces. And generally markets, I think, struggle to focus on more than one or two key topics in their decision making. Yeah. We have how many topics to think about right now? So yeah, look, it is difficult. It is difficult.
You alluded to an inflation problem in Europe earlier. What does that look like?
So what I'm concerned about specifically as we head into the winter is two things. First is that gas storage levels are very low relative to history. So I think maybe 15-year lows and about 15 or so points below where you'd normally be at this point in time. I think it's not necessarily alarm bells ring quite yet because of the weather forecast and for the next couple of months, but we could get there if suddenly you go into a cold snap or period. So the gas situation, I think that's the first thing, and spot prices of gas are double where they were last year. And maybe just to also reiterate, like UK, Italian, retail, consumer, household, utility, energy bills will get affected by that if that manifests itself in the next few months. The second one is really refining, which I think has probably been talked about a little bit less, whereby refining margins are at record highs effectively. And the problem is that whilst this conflict persists, we're not getting the reversion that many of us expected, and that will continue to feed through in terms of prices at the pump and actually also in time in other areas of inflation, because there are some pockets of the economy, if you think about, for example, in Southern Europe, where actually industrially they use diesel and some of that input for energy pricing.
Do you think the AI story continues to overshadow the energy story? And what is your preferred AI trade right now?
In Europe, it does overshadow for now, but as I said, I will be keeping an eye on this as we go into winter. My preferred trade is to think about how it evolves as we move into token cost deflation. It's already happened a lot, but it's going to continue to happen further. We're seeing not just the Chinese labs drive that, but also the American labs move and cut pricing across the board. So what does that mean? I think that means thinking about people who can benefit from more than just pricing. So far it's been a lot of areas of the value chain whereby there's been tight supply demand, you benefit from very high pricing, high margins. I think going forward is about where does that sheer surge in volume benefit? And so that can mean companies, whether it's on the hyperscaler side, whether it's on the semi side, whether it's on the industrial side, whereby it's more about operating leverage and volume rather than price.
Just quickly, so you wouldn't buy Anthropic?
Can't comment on specific ones, but I would say, generally, the community is getting a bit more concerned about frontier labs.
Okay, that's quite a big statement. I can't let you go without telling me where to have dinner. Give me a restaurant recommendation.
I hope you've been to some of the recent ones that I mentioned before.
We have. But there's been a lot of kind of shortage. There was a lot of shortage for a while.
I'll give you a non-shortage.
Now you're moving.
Should we give some context to this?
So, for long-time viewers, you know that this guy has what is it? Restaurant at Bernie's?
Yeah, so I write a newsletter on LinkedIn called Weekend at Bernie's.
Weekend at Bernie's.
And the end of the newsletter has a brief restaurant review.
Yep.
Basically, I just love eating. I'm eating out in London all the time with my family and friends. So the one I'd be recommending very highly at the moment is Impala in Soho, so it's not shortage.
Yeah.
Pretty new. It's cooking over the fire. You have a lot of Egyptian, North African influences. Very buzzy atmosphere, great service, just all around, good place to go.
Weekend at Bernie's. There you go. Sorry. Restaurant at Bernie's. How did I... easy mistake to make, but big one.
Next time.
Next time. No. We'll keep you coming back and get those restaurant recommendations. Bernie Kong, Diamond Asia Capital Partner and Portfolio Manager. Okay. Let's talk a bit about where we are with the market this morning. This is the story that we find ourselves with in terms of the core six. You are seeing ASML catching a little bit of a bid. You've seen a better bid coming through from some of the Asian chip makers overnight. Schneider's also up. But elsewhere, it's a pretty tepid performance. Defense stocks are down. Even Nestle is a little lower this morning. Novo's down. Big move yesterday, obviously, on the back of the RNA story. And we continue to watch that with great interest. But let's talk about some of the other market movers we are watching. Novonesis is first on Alex's list.
Well, yeah, Guy, it is. You can't do that to me. I've not had breakfast yet. All that talk of food. You've got me, got my stomach rumbling. All right, but let's look to the movers then. Novonesis, yeah, up as much as 11% this morning. That's off the back of that raise in the full-year outlook, but also announcing that major share buyback. And this, of course, is the biotech firm. It was dairy products and high-protein products really giving them a lift. Currently up around 8%, excuse me, 8% and in the green this morning. Let's turn to JD Sports. Very different picture there, down as much as 10% this morning. This was after they cut their profit, more than 10% now, after they cut their profit outlook. Weaker demand for trainers in the United States, seeing as really hitting the sports retailer. They are far from their 2021 peak when, off the back of COVID, athleisure wear really was a buzzword. You can see Sports Direct suffering from that. They're also suffered from some supply issues with some of their main suppliers like Nike. So down around 10% this morning. Let's turn over to Aegon. They are also down this morning. The insurers announced the departure of the CFO to be replaced by spring next year. Despite some of the good news the company had, analysts were saying that could create some near-term volatility. You're seeing Aegon down around 3% this morning. They're holding that shareholder meeting in October, talking about their move to the United States. And finally, let's finish with Trainline. The conversation yesterday about that 17% drop. They're still down today, but around 4%. That's off the back of an announcement from the watchdog in the UK. They're looking into the pricing practices known as drip pricing. So Trainline also in the red, but Novonesis really the one leading the pack at the front in the green, as much as 11% this morning.
Alex Morgan, thank you very much indeed on some of the stocks on the move this Thursday. Coming up, following the US Treasury's plan then to buy back longer maturity debt, we're going to discuss the outlook for markets with JST Advisors founder and CEO John Turek. That conversation's coming up next. This is Bloomberg. 17 minutes into the Thursday opening trade. Let's check in on the markets then. Across the benchmark, you're flat. You're seeing losses in the UK. The FTSE 100 is currently down 0.2%. Basic Resources, after gaining as a sector yesterday, currently amongst the biggest losers. The DAX is currently down 77 points. Over in France, the CAC current flat as well. And you're seeing across the benchmark again, largely unchanged after 6 days of losses, Guy.
Euro dollar 116 and change. In terms of what we're seeing in the bond market this morning, you are starting to see a little bit of a shift, actually. The US 10 years just turned positive in terms of the session. You're getting quite a big kind of U-shaped story this morning. It doesn't look quite so U-shaped on a longer-term chart, but you are back to seeing Treasury selling this morning, at least at a 10-year tenor. Let me just see if I can actually just change the drop down and get to the 30-year, just give you an idea of what's going on. It's a similar story. So, yeah, 519 is where we're trading on a US 30-year. So stabilisation maybe is probably the best picture to describe what we're seeing. Big moves yesterday, though, obviously after Scott Bessent, the US Treasury Secretary, unveiled plans to buy back longer maturity debt. This came out of kind of left field. The move comes, of course, after we've seen global bond markets jolting higher in recent days, investors demanding greater compensation for the inflation risk and the deficit risk and the kind of the long-term trajectory risk of government debt in the United States. John Turek, CEO and co-founder of JST Advisors, joining us to discuss. John, what does this signal about how worried Scott Bessent is, the US Treasury Secretary, about these longer-term yields? This came out of left field from my perspective.
Yeah, no, I think you're totally right. I think what's interesting is that we had this announcement sort of 2 weeks before we had, after we had a refunding announcement from the U.S. Treasury. I also think it's noteworthy that sort of this announcement came in a context that was it was really just a yield move that was pressuring markets. There was no dislocation within Treasury markets per se, either looking at swap spreads or sort of off the run, on the run bond spreads. So this was just kind of, I think, Treasury Secretary Bessent laying a marker down that he was uncomfortable with the move in long end yields, and it was much more from a level perspective than sort of a Treasury functioning market perspective.
What if this is a short-term band-aid, as we've been describing it maybe on the show this morning? What is the longer-term solution to the problem, to the question that the bond market is asking? Is it that the Fed reacts and we see the Fed kind of getting control of inflation? Is it that the US government decides that actually maybe we shouldn't be cutting taxes, we should be hiking them, or maybe we shouldn't be hiking spending, we should be cutting it? What is the longer-term story here?
Yeah, I mean, I think the longer-term story here is that the market is dealing with a pretty immense imbalance between savings and investment. And right now, there is a huge call on global savings that from a pretty price insensitive sector, and now we kind of compounded that, right, where we've had this 3 or 4 years of increased fiscal spend globally. And now we've kind of compounded that with sort of hyperscaler issuance and sort of the AI CapEx story. And both of these dynamics in the market are very big sources and have very, very big needs for global capital. And I think the question sort of, in light of, inflation above target globally as well, is sort of what's the risk premium that the bond market should demand for sort of funding, both of these pretty material, investments. So I think the question, even outside of the Fed, I think is sort of how do we sort of right size the imbalance that's sort of taken place now between investment and savings. And I think it's a much more longer term question. I don't think it's one that's going to be solved with tactical moves. But I do think that, given the context of this tactical move and the potential signaling effect of it, I do think it is quite significant.
I do wonder if the consensus is that you have pressure on bonds regardless and you just have a price path higher for yields. Is the U.S. Treasury defending 475 on the 10-year? Do you just get more and more buybacks? Presumably there's a limit on that.
Yeah, no, there's certain. So, I think the interesting thing now is going to be the tactics around this move, because my feeling, and speaking to clients sort of following the move yesterday, is that you would assume that there's going to be follow through. Is this not just going to be a one-time thing, clean the shorts and then, next story? I mean, I do think that this, is going to be in the context of a battle now between, Treasury and the long end of the bond market, which is still in a structural trend weaker, higher in yield. And I think sort of the question is what is the next move? There's, a lot of different things that Treasury Secretary Bessent can come up with to sort of cushion the move. We saw the buybacks, no one really had that on their bingo card for yesterday. So I think that's one. I think the question, as this kind of goes on and what the scope of this intervention ultimately is there is going to have to be this balancing mechanism between the front end of the curve and the long end of the curve, because to do these buybacks, they have to issue more bills. It is a little bit of an operation twist, if we remember from the QE days, because obviously the Treasury runs a big deficit. So, to spend more money, they have to raise more money somewhere else. So does that eventually leak into, bills pressuring, front end rates? Does the Fed have to respond to that? Does the Fed respond to that with, as we saw last year, with reserve management purchases? So I think that there could be a lot of tension on a go forward basis if this is sort of the beginning of, something more material in terms of financial repression, long end repression, whatever nomenclature you prefer.
So, John, how do you think the Fed does respond to that? Because the markets are betting that there's less of a likelihood that they hike rates now, and part of that may be down to the minutes, but part of that down to this operation as well. They've pushed out those expectations. Is the Fed less able to address inflation risks if there is more issuance at the front end?
Yeah, it's a good question. I mean, I think that, there's two ways to look at this, because the first way is that so much of the hold in July was conditioned on this idea that financial conditions were tightening from long end real yields going up. And Warsh, even in his press conference, sort of noted that this was, quote unquote, the market doing the work for them. Now, so, from a, intellectual perspective, it's easy to say that yesterday's move kind of undoes that in a way. But I don't think it's a clear read for what it means for the September meeting, because in the context of this, we've also had data that's kind of leaned in the more dovish direction in terms of the inflation and non-farm payrolls we've gotten so far in August. So I don't think it's clear, what it means for the Fed. I don't think this is something that they'll address. But I think given that they've conditioned a little bit of the reaction function we have in terms of real yields doing some of the work for them, which was something that was pretty clear in the July presser, I think it's going to be something to watch, sort of how they interpret this. But I'm not sure it's a clean read on what this means for September in either direction.
Where do you think it shows up the most? Obviously, we've seen a big market reaction in the bond market. Equities less so, but a big market reaction in the dollar as well. Where does this kind of show up, do you think, next?
Yeah, I think the dollar is really the place to watch here because what, functionally I think this does in a sort of textbook, financial repression way is you're moving one imbalance to a different asset price. And the way that this should leak is if that, long end real yields are not able to sort of equilibrate in the way that they quote unquote want to, that will have, a lot of positive influence on financial conditions, which should leak through predominantly the FX side. And I think that that's sort of the place to watch here. I don't know that it'll be sort of this like straight line. I think the market got very excited yesterday. This is sort of like some introduction of QE. I don't know if it's, to that extent yet. But I think you have to be cognizant now that the tail on the dollar has gotten bigger because, if this policy does have a go-forward basis and it's one in the context of the Fed not hiking, I think it's the dollar is really the cleanest outlet for that.
Okay, John Churek, really appreciate your insights this morning, CEO and co-founder of JST Advisors. Switching focus coming up, the UK tech startup which has raised $100 million in early financing in a bid to break the Nvidia monopoly. We're going to speak to the co-founder of Callosum. That is next. This is Bloomberg. Happy Thursday. We are 30 minutes into today's session. Across the benchmark, you're seeing losses of 0.1%. If this continues, it will be a 7th straight day of losses for European equities, with the context, of course, that we are in the middle of August and volumes are pretty light. The DAX is currently down 109 points. The CAC current over in France is off by 0.1%. And the FTSE is just at 10,718, just down 0.2% so far. We're going to break some news for you on the central banking side. Sweden's Riksbank decision coming through. The central bank keeping, as expected for our own economists, rates on hold at 1.75%. The estimates were for that hold, of course. You're looking at the currency largely unchanged on the back of that move. We are focused on guidance and our team of economists expecting some guidance around the inflation risks, of course, linking to the Middle East. Guy?
Yeah, probability of a rate increase later this year remains. That's the line that maybe ticks that box on the guidance front, Tom. Let's talk a little bit about where we are in terms of the market internals. 254 up, 333 down. I'm not sure there's a clear sense of direction for European equities this morning. Volume is light once again. We remain in mid-August. Let's talk about precision engineering. Sartorius raised this morning at UBS. Market reacting fairly positively to that. So we'll keep an eye on what is happening there. Michelin upgraded at JP Morgan. Market likes that as well. We're up by 4.4%, 1.9% on Sartorius and Michelin. Swatch is up this morning as well. A little bit of a pick, actually quite a decent pickup in terms of what we're seeing in terms of watch exports to the United States. We're up by nearly circa 10%. That is lifting the Swatch story quite nicely. Swatch up by 2.73%. There's some downside this morning. Apparently sneakers, trainers, call them what you will, under a little bit of pressure. JD Sports Fashion down by 12% on the back of that. We spoke to the Aegon CEO a little earlier. Market's not keen on the CFO exit. Remember, this is a business that is transitioning to the United States, and that plus a few other factors drowning that stock a little bit, down by 3.4%, 3.5%. And Orkla down by 6.54%. But we're reasonably balanced. Upside, downside, that seems to be the narrative. Equity markets, once again, kind of going sideways. Up or down, we'll wait and see what the end of the session produces. We've been drifting lower over the last few sessions, Tom.
OK, here's what else you need to know this morning. President Donald Trump has announced plans to inflict what he called an economic economic D-Day against Iran. Trump didn't specify what measures he would take, but his threat to target Iran's trading partners, none of which he cited by name, puts an immediate focus on China, which buys the bulk of Iran's oil. Total US public debt has surpassed $40 trillion for the first time, with a surge of a third in less than 5 years. The news came hours after the Treasury Department announced it's ramping up a buyback program for longer-dated securities to rein in long-term borrowing costs for multi-year highs. Samsung and SK Hynix are preparing record shareholder returns after investors sent their stocks tumbling over concerns around the sustainability of AI hardware spending. According to reporting from Money Today, Samsung will soon announce a plan worth more than $72 billion, and SK Hynix already unveiled its plan to buy back $29 billion of stock, with JP Morgan saying the company may follow that up with additional returns worth at least $130 billion. Guy.
Let's pick up on that and talk to Neil Campling about what we are seeing here. Good morning. What's the signal? What are these companies telling us? The stock prices have obviously come down fairly sharply. We've bounced a little bit. Are they telling us they think their stock is undervalued? Are they trying to lift it further? What's the message?
There's a couple of things going on here. They are telling us that there's a lot of free cash flow they're generating now and expected in the future. We have to give some context to this in that, don't forget, in June, Samsung were facing this labour strike, and there was a 90 trillion won package, basically, of buybacks expected to cover just the bonus payments for employees. So when, and Samsung have said basically on their earnings call recently, that they will detail when it's right timing and regulations, etc., about what the best efficient use of the capital is. Both companies, though, are basically paying out about 50% of free cash flow. So if you like, Samsung's saying whatever Hynix can do, we can do more.
That's the message.
That's the message, especially when you know these two companies are obviously significant rivals, and Samsung is the biggest of all out in Korea.
Alibaba is re-emerging as a favorite tech stock. It highlights the kind of US versus China divide, and they report earnings later today. What do you expect?
The stock has risen 35% this quarter. As you mentioned, it's been very popular, been very positive. They've had 12 quarters in a row of single-digit revenue growth. So are we going to get a double-digit growth number? We kind of need that. Street's at about 8%. That needs to kind of come through. It's all going to be all about QuenWork. QuenWork being their AI, the AI which they have is almost at the frontier AI performance at a much lower cost. Is that going to translate into accelerating growth? That's what we need to see. If it comes through this quarter or it's too early, that remains to be seen. And we've seen the likes of Tencent and Baidu in terms of the price reaction to their stocks recently has been negative because they haven't seen the investments in AI paying off yet.
OK, Neil Campling, thank you very much indeed, breaking down what we're seeing in terms of the buybacks and the proposed buybacks over in South Korea, and looking ahead to Alibaba. We'll stay on the AI story because UK startup Callosum has raised $100 million in early financing from backers, including the UK's sovereign AI fund. The company is attempting to break the AI monoculture with software that can match various AI workloads to the models and chips best suited to them. Callosum co-founder Danyal Akarca joins us now. Dan, congratulations on the raise. Just expand on that then. What is the proposition? What is the problem that you and the team are trying to solve?
So, firstly, thank you. It's great to be here this morning. So taking a step back for a moment, obviously AI is exploding right now, and fundamentally the fuel, the engine behind the growth of AI are chips. And it's a very exciting time because there's an explosion of new chips that are coming to the market right now. Many countries are building their own chips, and these chips are very specialized for different use cases. They have pros and their cons. So some chips are very energy efficient, some are very fast. And it has led to a very interesting dynamic where end users and companies really just want to have the best AI that's faster and cheaper than it is today. And really that calls for a company like Callosum that is chip agnostic, that is global, that is able to take AI systems and to be able to optimize them for the right chip. And this is why we're so excited. We've shown that we can make AI systems faster, better, and stronger by utilizing these combinations of chips. And so we're super excited with our $100 million seed round in London to scale globally and to partner with many exciting new chip companies.
Is this also about breaking the grip that NVIDIA has right now?
So, as I mentioned, from our perspective, really, the best AI systems really for end users are ones that use combinations of different systems. Inherently, that means partnering with a large range of different players. NVIDIA have amazing systems. We collaborate very closely with NVIDIA right now and are super excited moving forward to do more. But we're also excited to announce our new announcements of our partnerships with Cerebras, for example, who are bringing incredibly fast inference chips to market, in addition to others like Rebellions in South Korea.
Does that mean we're going to be building data centers with multiple different types of chips in them? And then your system basically goes, I can use that for that, I can use that for that, and I can use that for that.
That's exactly right. So inherently, it doesn't necessarily have to be in one data center location. It could be over several different locations. But ultimately, what we found is that you can get efficiency by using those different chips. And that's purely for the simple reason that different chips have different benefits to
characteristics.
Them. Exactly. And so you can get efficiency by being able to scale the number of these chips. That's one way. The other is through what we call heterogeneity, by utilizing the different properties of those chips. And with our software, we can actually extract the benefits of those chips.
One of the big things that is being talked about in the industry at the moment is effectively the sort of securitization of chips. One of the things that comes with that is we need to understand the kind of the lifespan of chips. Does this mean that kind of older chips actually have a role to play? Because you can go, okay, that's not the most cutting edge, but we can keep it and we can use it because actually we can kind of downgrade it and use it for something else.
Totally, and we're already seeing that happening right now. So actually many of the older chips available on the market are doing incredibly well. That's for a few reasons. One of them is that we're finding that there's actually many different models that can be used to run economically viable workloads. And some of them can be quite small. Those models, and as a result, you can use these kind of older chips really well. That's actually part of what we're working on significantly, is how do you extract performance from older generation chips so that they can have longer lifespans, and how you can ultimately run them to be far cheaper and more energy efficient.
Chips are also something that governments have kind of protected within a country. Does that mean you have more sovereignty over how AI is used?
Yeah, exactly. So in the limit, this is a way in which you can build AI systems using a combination of different chips. What that does is really a kind of a great future for AI. Ultimately, it's democratizing the infrastructure in which we can build AI systems. We are very proud to announce, obviously, a funding round and the first investment from Sovereign AI in London, in the UK. And really, kind of sovereigns and governments are finding that's incredibly important to them. If you can widen the access to your supply chains, that gives you increasing leverage. It gives you increasing options, and is one in which you're not kind of bottlenecked by any one single provider.
And it's about not being dependent on not just the chips but also the models as well, right? So, and we're seeing this price pressure on tokens, so a price war. And we're seeing that, and China's been part of that, the open source, of course, the open weight models there. Where are we in that journey? Do we get commoditized? Where do you think the trajectory is for token prices?
So I've just outlined kind of on the supply side, I guess, on the chip space, which is going increasingly heterogeneous. But you could also say the same on the demand side. So on the demand side, with the models, they're also becoming increasingly heterogeneous. What we're finding is that actually how AI is really used has changed. So people used to think that you would run everything, all of your tasks, through one big model. Right, and that was kind of the main vision that we'd had over the last few years. What we're really realizing now is that tasks actually are much more complicated than that in reality. You can actually break tasks into subtasks, and as a result, you can actually use many smaller models to be able to do many of the most economically viable work. And yes, you can actually make that could be a lot cheaper to run. And also, by optimizing those models to the correct chips, you can get even greater performance. And that is really amazing for token efficiency.
I do wonder, we're spending loads of money on AI infrastructure. If we become more efficient, is that just not needed?
I think there's two things here. One is obviously a huge infrastructure spend that's going into AI. Actually, there's two things here. One is that we do think that the market is going to grow significantly. So it's very hard to determine exactly the degree of this. So ultimately, there is a great amount of infrastructure spend that's been going on into this. It's not that it won't necessarily be needed. Actually, if you make the tokens much more efficient, it means you can actually do much more work. The classic Jevons paradox case. And so that's actually what we're seeing. We're making AI systems far cheaper. And as a result, for example, in case of cybersecurity, you can actually have much more cybersecurity that happens because it's cheaper to be able to run. So it's hard to guess kind of precisely. Time will tell. But we think actually moving towards a case where it's much more efficient actually means that you can make the most out of your infrastructure and potentially do better and more AI.
How long do you think chips are going to last for? It seems to come. If I'm going to securitize a chip, I want to know how long it's going to last. Is this something I amortize over 5 years, 7 years, 10 years?
So
what do you think?
It depends slightly on. Okay, so there's no really easy answer.
I'm sure there's no easy answer to this.
So the first thing to say is that it depends on the nature of the chip itself. But what I'd guess to say is just looking at the trend, we've seen that actually they have a longer lifetime than I think previously we'd have been expecting. And this is purely for the reasons we said earlier. We're extracting more, let's say, intelligence density out of the chips. There's more that you can do now, and there will be more that you can do in a year from now with that same chip. And as a result, the value will just kind of float with what you can do with it. So I'd be pretty bullish on what you can do with all the chips.
Dan, where's your revenue coming from? Who are your main customers? How much of that is stateside? And what is your level of commitment to remaining a UK business?
So there are two groups of customers that we work with, what I call people who consume intelligence. So they just want AI to be faster, better, stronger, and cheaper. And so we're working with amazing companies on that side. The other are people who are building up the capacity for intelligence. So the data center builders, the sovereigns, and so on and so forth. You asked me about in London. We are super excited to be here in London. We have an amazing world-class team.
You remain a UK business.
So we are a UK business. We are inherently global in terms of our outlook and scaling globally. But we are very, very proud to be based in London. Unbelievable talent here and recruiting the world best team.
Dan, great to see you. Thanks for stopping by to see us. Really interesting. Kind of filling in a lot of the blanks that we're trying to answer questions around at the moment. Dan Akarca, the Callosum co-founder. Thank you very much. OK, coming up, what are the results from Walmart going to tell us about what is happening in the economy? You've got a lot of big box retailers coming through with numbers right now. Key test in terms of the state of the US consumer. We'll debate that story next. This is Bloomberg.
Welcome back to the opening trade. We are 48 minutes into today's session. European benchmark stock 600 is currently flat after 6 days of losses. Volumes, of course, are light. It's worth noting that. The DAX is currently down 0.3%. The CAC current is flat, as you can see. And here in the UK, the FTSE 100 is down just 21 points. Let's look ahead to what else we are watching throughout the day. Monte Paschi and their board members will set to review strategic alternatives to Intesa's takeover bid, so a focus on the Italian banking space. On the earnings front, Alibaba will be dropping their numbers at around 11 a.m. UK time, and when it comes to retail, Walmart is at 12 p.m. UK time. On the macro front, 1:30 p.m. UK time, you have US initial jobless claims, and later the ECB's governing member and Dutch central bank president will be speaking on central bank independence. Guy.
OK, let's talk about what's happening with the retail story. Big box retailers in the United States, give pretty good clues as to what is happening with the US consumer. Walmart results, as Tom was just saying, investors are going to be watching for commentary on the health of the consumer, amongst other things. Ruhel Aman joins us around the table. We need to talk about the UK story as well this morning, but let's start over in the United States. What's Walmart going to tell us? What signal will we take away from the Walmart numbers later?
Yeah, so Walmart is really a bellwether retailer. I think it's going to be less about the headline beat, more about the composition of the beat. Same-store sales growth, obviously the key metric that the market's focusing on. If that's going to be driven by ticket and they can show evidence of market share gains and operating profit growing faster than revenue, then I think it's going to be a net positive. But if the composition of same-store sales growth is a bit more even between traffic and ticket, and we see a modest beat, conservative guidance, then I think the premium valuation that the shares trade on going to come under a lot of pressure.
We've had other retailers report overnight. We had Target, TJX, Lowe's. What was their performance?
Yeah, so it's been a real mixed bag, but I think, obviously the consumer in the US has been under a lot of pressure throughout the course of this year. Inflation's been elevated above target. Gas prices have been high for some time now. And what you're starting to see is the consumer still spending, but becoming much more selective about how and where they spend. And I think that favours, players with scale, and particularly some of the non-discretionary big box retailers, Costco's, Walmart's, etc., who can demonstrate value a bit more effectively than some of their peers.
How broadly should we look into the JD numbers? So JD Sports, the stock reaction is pretty brutal for that company. Is there a broader read across in terms of the health of the consumer here? What do you make of those numbers?
Yeah, very much so. So, retail stocks have rallied quite strongly. I think JD Sports is up about 40% from its May low. So there was a lot of, lot riding on this print. But I think what's jolted the market is commentary around the consumer. They said that their core consumer is showing signs of softness, and that's what partly drove the cut to full-year profit guidance. And I think that's why you're seeing such a nasty sell-off, because it seems like cracks are emerging in the consumer.
Are you seeing that elsewhere in the retail space? It's hard to get a read on the UK consumer at the moment because the data, the official data is really bad. So this is actually quite useful information. Is this being replicated elsewhere? Is this the first big tell on what is happening with the consumer, or is there information elsewhere saying the same thing?
Yeah, I think some of the macro data has been mixed. I know Adam's spoken about it. But, obviously with a single stock like JD Sports, you're really getting quite a direct read on discretionary demand. And there obviously are some more company-specific issues with JD Sports. They mentioned the product cycle and some issues with their partners, but I think it's the commentary on the core consumer where they're seeing softness, which has spooked the market.
Yeah, understandably. Rahul, nice to see you. Thanks very much indeed. Rahul Ahmed joining us on what is happening with the retail space, the consumer space. Adam Linton, as we were just mentioning, sitting around the table as well from our Markets Live team. We're still dealing with a little bit of the fallout from the macro story yesterday. This morning we're getting signs of stability maybe within the bond market, but equities are continuing to drift sideways.
Yeah, I don't think really equities equities is really the story of the week. I think it's very much what's going on in the bond market. I think what we saw yesterday was showing the signs of stabilisation to some extent. The actual actions weren't that important. It's very much the signalling mechanism. And in the US, this 4.75% level is some sort of pain point at the moment. I think the thing is, though, is that does this really stop the tracks, if US yields moving higher? Does it address the factors that we've been discussing throughout the week? Strong underlying US growth, rolling fiscal deficits, and some of the hyperscaler capex competition. And I think what we've seen, it's a very different asset class and different case, but absent a shift in fundamentals, it's hard to turn the tide for an asset. If you look at the Japanese yen, for example, yes, there was efforts to try and control it, but the market has said otherwise. And I think, what I look at for European bond markets, I don't think it's really that relevant. I think, yes, you see spillover buying from US paper into European paper. But as we saw last week, the US inflation data, that has a very limited runway. And, unless fundamentals shift in favour for Europe, it's unlikely to have much of a durable effect. We saw hot PPI numbers for Germany this morning, and we've discussed about all the fiscal strains in Europe throughout the week. And I think from a supply perspective, keep an eye on the French auction today. Typically not a market mover, but definitely one to watch.
We've had softer US data. That's fed into less hawkish pricing for the Fed, but nothing's really sustainably pushed Eurodollar above 116. We got that yesterday. Is the path higher from here?
I think it can keep grinding higher, but in terms of the bigger levels, like the 120s, I still think we need a bit of better Euro story. I think if you look at the price action we've seen so far, it's very much just been dollar-led. We've seen that scaling back the Fed hike expectations. We've seen the Treasury buyback, which has brought in dollar credibility concerns. But if you look at the euro, month to date, it's relatively middle of the pack G10. It's not really doing anything that exceptional. And I think it needs a bit more of a geopolitical off-ramp. Yes, inflation is increasing, which warrants a monetary policy response, but really it does look like a fairly priced for the ECB at the moment. And if this, does escalate more, there's also a terms of trade shock, which limits the extent to which the ECB can hike and support the euro. Then also from the dollar side of the equation, we're on this glide path lower towards pricing out hikes. But I still think that's not a given at this stage. The market's trading a reaction function. It still doesn't really know a lot about. And, we saw there's a bit of a credibility hit from the FOMC in July. If Walsh looks to reassert that at the Jackson Hole Symposium next week, that could potentially reinvigorate a bit more of a hawkish skew around the Fed.
You mentioned geopolitical off-ramps. No signs of that right now when it comes to Iran and the Strait of Hormuz, and you're looking at Brent now above $93 a barrel, so up 1.5%, 1.6% in the session. WTI above $87 now. That continues to be a grind higher as well on oil prices.
Yeah, it does feel very much like risks are still tilted to the upside. I mean, we know there's no direct negotiations between the US and Iran. This Iran-Oman shipping agreement hasn't been achieved. Iran's, revitalizing its offensive and defensive capabilities. The Red Sea is still an active conflict zone. And I think in terms of the way the market was trading it back in kind of April, kind of May way, was that there is kind of an off-ramp, even if news flow is negative, that the US will take at some point. And the pathway is towards a resolution. But what we've kind of seen from the US administration is we've seen Trump say, not in a hurry. And then we've also now seen these kind of economic warfare, which also escalates things. It brings China into the mix. And as we've seen with Russia and Ukraine, the sanctions aren't a quick fix to a conflict resolution. And alongside this, Russia-Ukraine, that's still rumbling on. That's removing a buffer of support, which could drag oil prices lower. I just think after getting burned with the collapse of the MOU back in July, I think the bar to reprice oil low is pretty high at the moment.
OK, Adam Linton from our Markets Live team, thank you very much indeed. Let's check back in on the bond space right now. Largely unchanged when it comes to the gilt markets. Treasuries, you're seeing very, very modest selling. You're at 465 right now on the 10-year. Skylar, as we wrap up the 2 hours on opening trade today, what do you think is the key takeaway in terms of the action from Bessent?
I mean, I think it's the dollar. It's the credibility issues.
Dollar.
Yeah, and I think it's the Fed as well. We need to see what their reaction is to this, to see what the implication for the dollar is, right? If Warsh comes out and doesn't take this hawkishly, maybe that's even more pressure on the dollar.
Yeah, it's going to be interesting to watch. Yields are beginning to turn around. We're starting to actually see a little bit of selling coming back into the market. Talking of the Feds, Mary Daly's going to be on TV a little bit later on. We're going to be talking to her at 1:30 p.m. London time, the San Francisco Fed president. That's going to be an interesting conversation. The Pulse is next. This is Bloomberg.